All right, let's start off. Are you concerned about the stock market volatility? Yesterday I met with a couple wonderful people. They've done a great job saving. They've got 90% of their money in stocks, 10% in bonds. And even though they know that they probably should have reduced their risk by now, it's really paid off to have stayed aggressive. And one of the things that we talked about was sequence of returns. So really the big question that they asked me was, hey, what happens if we have an early correction versus, the market just continues to do well? How does that impact us? And a lot of people realize, obviously, if we have a correction earlier on, there's some challenges that we could face, because now all of a sudden you're not collecting a paycheck. Now all of a sudden you've got the market is dipping, and you got to pull or sell stocks and bonds at a loss to get that paycheck. Yelisey, what are some thoughts around that?
Yeah, I mean, it's one of those things that it's easy to graph it out and to show you, hey, of course, if you have a correction in the earlier years, it's not going to bode as well for you than if you have one later on. But in reality, probably over the course of retirement, you might experience several corrections. And, it's a simple concept. If the market goes down and you're forced to realize those losses, you're going to have fewer dollars working for you in the market to help fund the rest of your retirement. So, of course, that's better to have that in the later years of retirement if possible. But, one of the things I often tell people is we're going to have multiple corrections. It's just going to happen. And it's not about avoiding it, but making sure that you're set up in a way that you can weather those storms and that you're aware of what's happening in your accounts, right? We don't want any surprises in retirement. And one of those things that we need to do is making sure that, hey, recognizing the season and the stage of life that you're in and planning accordingly.
I think too, one of the things I talked to them is I just said, just because we have a correction potentially coming doesn't mean you have to go from 90% stock to 50% stock. But do you have a bucket of money in CDs or money market, or do you have enough to maybe cover 2 or 3 years if it took the market that amount of time to come back? Yeah. So one of the things that I think we talk about is, have you done a stress test to say, if we have a dip, how much is it going to impact your overall portfolio? And I think one of the challenges is that in 2020, we had basically a 30-day dip and the market came right back. And then 2022, the market was down 18 to 20%, and it came right back. So I think, that was positive. One of the challenges is that it made a lot of people comfortable with higher risk than maybe they should be taking. Go ahead, Yelisey.
Yeah, I just think one of the things that we need to avoid is just making rash decisions, panic selling. And we have had a number of people. There's just so much going on all over the world, whether it's politically or just all the unrest and the wars that we have with Israel and Gaza and Ukraine, Russia. I mean, there's a number of things happening, not to mention the election. So we've had so many people calling in, and they're like, hey, not to mention that the market, we had a bull market for as long as we've had, if you exclude 2022, are we due for a major correction, like one that's actually going to last for several years and take forever to recover from? And, we just want to make sure that you can have those conversations, but on the other end of that, you should have somebody who's helping you avoid making some of the panic selling decisions that some people have kind of gone into. And, one thing too, the other thing that we have going on is we have October, and I don't know if you're familiar with this, Trey, but the October effect, right? The idea that October is more dangerous than maybe some of the other months to speculate in stocks. And we've had a number of clients that have mentioned, hey, are you aware of the October effect? And, the joke in the industry is, the other dangerous months are January through December. So,
well, there are some patterns sometimes. So what's the solution? I think one of the things that we've been showing people is historically the average, retiree had a 60-40 portfolio, 60% stock, 40% bonds. And one of the things I'd encourage listeners that are in and nearing retirement is to consider an alternative for some of those bonds. What are some of the options? One would be money market. Number 2 would be CDs. And number 3 would be a no-fee fixed index annuity. Some people love the word annuity and some people hate it. But one of the things that we like is the no-fee annuities, where your money's guaranteed safe. And if the market goes up, you get to participate in the reward or in the upside of the market. Now, obviously, those annuities are not a comparison for your stocks, but they can be a great replacement for bonds, typically averaging 3 to 6%, especially, if the market does well, then they can do better than that. But one of the things that we found is a lot of people realize that they're in a new season of life, and there may be different financial vehicles that didn't make sense before, but they might make sense now. What are your thoughts on some of the alternatives that we've been using, Yelisey? And for somebody that maybe they've only had bonds for safety, what are your thoughts on some of those other three options, money market, CDs, and annuities?
Yeah. So, the money market fund is fantastic. You have liquidity right away. You could take the money in, put the money in, buy the fund, you can sell it, and you can have cash available anytime. So that's really nice from a liquidity standpoint. The only downside is, they base the return on the money market fund based on a 7-day average, the previous 7 days. And it's entirely dependent on what the Fed is doing in terms of the interest rate. So, you could be getting a great rate of return today, but 6 months from now, that fund might not necessarily return what you're hoping to get, or at least what you would want to get from something that's safe, right? And you could be missing out on market returns that could be quite a bit better than that. So that's kind of the downside, right? You have no control over that, and it can change very quickly in terms of the rate of return. So if you have CDs, you have a longer term. So that's kind of nice, right? You can actually, if the rates are competitive, if the rates are good today, whether it's a CD or a treasury, you can lock that in for a period of time, whether it's 6 months, 9 months, 12 months, even more than that, right? Treasuries can be several year-long treasuries where you can guarantee that you're having, this specific rate of return for the next 10 years. The downside there is, if you're locking the money in, so you don't have as much liquidity. And also, depending on what happens in the market, maybe you could have some opportunity cost if the market ends up significantly outperforming those types of investments. But at least it's relatively safe. You don't have to worry about that. But the other thing is, if you have some of those things in a brokerage or an after-tax account, you'd have to pay interest or you have to pay taxes on the interest and some of the dividends and things like that. So sometimes you may not want the additional exposure that income could provide. And that's where the fixed indexed annuities and some of the things that we've looked at, they allow you to defer all of your gains and defer the taxes on those gains until you take a distribution. So there might be some advantages there too. So,
yeah. Well, I think one of the things that a lot of people haven't done is, let me start with what they have done well. Most of the families that we meet with, or the individuals, they've done a great job saving. Their advisor, the 401k, did a good job, growing money, which is obviously the goal. But one of the things we found is most people have never had a conversation of what does it look like to take monthly income from this portfolio that I've only added money to every single month. What does that look like? And so we call it, your paychecks and your playchecks. So for many of you, you're going to turn on a pension. You're going to turn on Social Security. Maybe you have some income from farmland that you inherited, or maybe you've got income from some real estate or a rental property. But most of the time, there's still a gap of those guaranteed income sources and your expenses, especially that first 3 to 5 years of retirement, when you're traveling more, when you're remodeling the house, you're hanging out with the grandkids. And so one of the things we help people do is put together a spend down plan and say, hey, when I get a paycheck on the first of every month from my investments, where do we pull it from? How do we decide if it comes from the IRA money, the non-qualified money, the Roth account? How do we know if we take it from checking or savings? And does the market volatility play a role in that? And the answer is yes. So one of the things I would encourage you is, if you've never sat down with a retirement planning specialist and put together a vision for your retirement, if you've never looked at your current plan and your portfolio of assets and how it could change in this new season of your life, we want to walk through an analysis with you, give you some recommendations. And for many people, we're confirming that you're already doing the right things, but maybe there's 2 or 3 things that you could tweak to improve in your new season of life.